Welcome back to the channel. This is Calvin Mateo, where we decode the market's biggest moves before the crowd catches on. Now, if you think today's run is just another speculative, hype-driven pop that will fade by tomorrow, I promise you, you are missing the bigger picture. You are missing the massive options trap that got sprung, the quiet institutional accumulation, and the fundamental reality unfolding right behind the scenes. Today, we're going to break down the exact sequence of events, decode the options chain mechanics, and map out the ultimate trading setup so you can decide for yourself where this stock goes next. And real quick, before we dive into the deep end, if you enjoy breakdowns like this one, do me a small favor and tap that like button and consider subscribing to Calvin Mateo. It genuinely helps the channel grow and it makes sure you never miss the next big market moving story. All right, let's get into it. But here's the thing, everything I just told you is only half the story. When we look at the breakout metrics on the screen right now, we're witnessing something rare. This is a perfect alignment of fundamental, technical, and structural forces all firing at the exact same time. On one side of the equation, we have blowout operational growth, with revenue surging 454% year over year. Let that number sink in for a second. On the other side of the equation, we have a massive short interest, representing up to 28.8% of the entire public float. Think about that. Nearly a third of the available shares were bet against this company. So what happens when hyper-growth fundamentals like these collide head-on with a heavily trapped short position and an extreme option skew? You get an explosion. You get a historic short covering cascade, a chain reaction where every forced buyer pushes the price higher, which forces the next buyer in and the next. That's exactly what ignited today. But here's a question worth asking. While these growth numbers look absolutely incredible on the surface, is there something hidden beneath them? Because there's one specific gap accounting metric we're going to look at in just a moment that completely changes how we evaluate the risk here. Hold that thought. To truly understand how we arrived at this explosive moment, we have to rewind the tape and trace the catalyst timeline of the last 90 days. Because this didn't happen in a vacuum. This was a story of fear, capitulation, and then a violent reversal. Back on June 22nd, Nebius was flying high, trading at an all-time peak of nearly $300. Everything looked perfect, and then the panic set in. Investors started to worry. Then worry turned to fear over the company's enormous capital expenditure guidance of $20 to $25 billion. The crowd became convinced that this level of spending meant one thing, massive share dilution ahead, and so they sold hard. This wave of fear dragged the stock all the way down to a local bottom of $145.80 on July 29th. Imagine holding through that, nearly cut in half. But then the tide turned, and it turned fast. Nebius secured a $775 million GPU-backed debt facility and then revealed a bombshell that Nvidia itself holds an active 9.3% stake in the company. Suddenly the narrative was cracking. Even when local regulatory delays at their New Jersey Vineland facility hit the news, and even when a short disclosure from the legendary Michael Burry dragged the stock back down to $184 on August 10th, something remarkable happened. The technical floor held. It held perfectly, and in doing so, it set up the ultimate pre-earnings coiled spring, loaded and ready to release. So here's the question. If we dig deeper into the actual numbers that dropped this very morning, can we see exactly why the bears got caught so completely off guard? Let's find out. Today's earnings report didn't just beat expectations, it completely shattered the bearish narrative, the whole spending without returns story the shorts had been telling. Q2 revenue surged 454% year over year, landing at $582.3 million, blowing right past the consensus estimate of $569.9 million. But the real shockwave, the thing that sent the bears scrambling, was the profitability inflection. See, the entire street expected margins to get crushed under the weight of all that heavy investment spending. Instead, the exact opposite happened. Adjusted EBITDA swung to a positive $236.2 million. Compare that to a loss of $21 million just 1 year ago. That is a stunning 40.6% adjusted margin. And with their core AI cloud segment driving 98% of that revenue and their annualized run rate skyrocketing to $3 billion, Nebius proved something critical. Their unit economics are highly profitable the second their capacity goes live. So this raises an intriguing question. How on earth is a company scaling this, aggressively managing to fund its massive hardware expansion without constantly diluting its shareholders? The answer is genuinely brilliant. The secret lies in their unique business structure, something they call the Soperator model. Today, Nebius officially announced they have closed 4 landmark AI cloud contracts, each one averaging over $1 billion, 4 of them. But here is the critical piece, the part that changes everything. 70% of those signed deals include upfront customer prepayments. Read that again. Their customers are paying them in advance. This means that upfront customer cash is covering 50 to 60% of the associated capital expenditures. Do you see the genius here? By having financial partners fund the physical data center facilities, while Nebius simply licenses and operates its proprietary software stack on top, they have systematically de-risked their entire $20 to $25 billion capex pipeline. They're building an empire using their customers' capital instead of dilutive equity raises that would hurt existing shareholders. It's a fundamentally different game than what the market feared. But now, here's where I have to be completely honest with you, because none of this matters if we ignore the risks. And there is one glaring reality we absolutely have to address head on. While the adjusted metrics look phenomenal, the gap reality is exactly where the bears are anchoring their entire case, and they're not wrong to look here. Nebius reported a GAAP net loss of $190.4 million. That's a real number, and it's heavily weighed down by $259.7 million in depreciation and amortization, plus another $102.5 million in share-based compensation. This depreciation figure is the exact core of Michael Burry's short thesis. Now Burry, the investor made famous for calling the 2008 housing crash, shorted this stock at $211.77, and his argument deserves serious consideration. He argues that AI cloud providers systematically overstate their true economic profits by depreciating their expensive GPUs over a slow 5-year cycle. But here's his counterpoint. In reality, hardware obsolescence in this space likely occurs in just 2 to 3 years. New chips make old chips obsolete fast, so if Burry is right about those chip lifespans, then these heavy depreciation charges won't just disappear, they'll remain a structural drag on any pure cash flow model of this business. It's a real concern, and any honest analysis has to sit with it. But while the bears debate accounting life cycles in spreadsheets, Nebius has quietly locked up the physical supply chain in a way that very few competitors on Earth can match. In a world where securing AI hardware is the ultimate bottleneck, the single most rate-limiting step in this entire industry, Nebius possesses an almost unfair strategic moat. Remember that Nvidia stake I mentioned? Let's break it down. Nvidia holds an active 9.3% stake in the company, comprising over 1 million directly held shares and 21 million pre-funded warrants. Now, is this just a passive financial investment, the kind of thing that means nothing? Absolutely not. This is a direct equity partnership, and it structurally locks out mid-tier neocloud competitors. How? By guaranteeing Nebius prioritized allocation to those scarce Blackwell chips and the upcoming next-generation Vera Rubin GPU architectures. Think about what that means competitively. When you have a direct, prioritized pipeline straight to the world's most valuable silicon, while your rivals are stuck waiting in line, your operational runway is virtually secured. And this massive structural advantage is precisely why the smart money has been aggressively accumulating shares behind the scenes. Let's look at the Q2 institutional ownership data because it tells a fascinating story. The smartest minds in finance are loading the boat. First, former OpenAI researcher Leopold Aschenbrenner's investment firm disclosed a massive 12.4 million share position, instantly establishing them as one of the largest independent holders. Think about that. A person who was literally on the inside of frontier AI research is making a huge bet here. Next, Orbis Allen Gray increased their position by almost 150%, now holding over $500 million in value. But the real standout, the one that made me sit up straight, is the quantitative giant 2 Sigma Investments. They added over 2.7 million shares. And what does that represent in terms of their portfolio? An absolutely astronomical 3,069% portfolio increase. And Vara added 2.5 million shares on top of that. Now here's the thing about quant funds like 2 Sigma. They don't run on emotion or hype. They run on cold hard data and mathematical models. So when data-driven quant funds scale their exposure by that kind of magnitude, you have to ask yourself, what are their models seeing that the panicking retail crowd missed? Their models were flashing a green light. But even with all this massive institutional backing, today's explosive price action still required a tactical trigger, and that trigger was the short squeeze. Heading into today's earnings, Nebius was primed, absolutely coiled for a violent technical squeeze. As we covered, short interest sat at a massive 60.2 million shares, representing up to 28.8% of the entire public float. And with a high days to cover ratio of up to 3.5 days, the short sellers had almost zero room to escape if the numbers came in hot. So picture the scene. The second today's blowout operational metrics crossed the wire, it triggered an acute squeeze. The bears were suddenly forced to cover their positions, and they had to do it in an extremely illiquid tape, meaning there weren't enough sellers to absorb their panic. This created a wave of price-insensitive buy-ins, buyers who literally didn't care what price they paid, they just needed out. And that sent the stock vertical. But here's the fascinating part. The physical short squeeze was only the first engine. The second engine was a massive options volatility crush. And this is where it gets really technical, so stay with me. Entering the report, the options chain was heavily skewed toward the downside. It sported a bearish put-to-call ratio of 1.47 for this week's expiration, and that number jumped to a massive 2.64 for next week's. In plain English, traders were overwhelmingly betting on the stock falling. On top of that, implied volatility was priced at an astronomical 157%, meaning the options were pricing in enormous expected movement. But then the earnings beat hit. And what happens to all that extreme implied volatility once the uncertainty of the earnings event is resolved? It instantly collapses. This caused a massive volatility crush that completely wiped out put premiums and out-of-the-money calls in an instant. And as those bearish hedges evaporated into thin air, the market makers who had sold them were suddenly forced to rapidly unwind their short positions, releasing an enormous wave of upward buying pressure directly into the market. And that unwinding process channeled straight into a highly concentrated gamma loop. Now stay with me, because this is the mechanism that put the run into overdrive. As all that direct equity buying pushed the stock higher, it ran headfirst into highly concentrated call open interest clusters. Today, we witness massive contract volume, with over 10,800 contracts traded at the 230 strike, nearly 5,000 at the 240 strike, and almost 9,000 contracts stacked at the ultimate 250 strike magnet. Here's why that matters. As the underlying stock price surges toward these massive call walls, the market makers who sold those options are reflexively forced to buy more and more shares just to maintain their neutral hedges. And this creates a powerful, self-reinforcing gamma loop that acts almost like a financial vacuum, sucking the price higher and higher and higher. So after all of this, after a genuinely historic 21% run in a single day, we have to step back and ask the most important question of all. What is this business actually worth? Let's look at the valuation multiple reset, and this is where things get counterintuitive in the best possible way. Prior to today's report, Nebius traded at 25 times its Q1 annualized revenue run rate. That sounds expensive, right? But here's the twist. Because their Q2 revenue run rate has now skyrocketed to $3 billion, the current valuation multiple has actually dropped down to 16.3 times sales, even with the stock trading way up at $234. Now here's the truly wild part. If Nebius successfully hits its guided year-end run rate of $7 to $9 billion, its forward multiple drops to an incredibly attractive 5.4 to 6.9 times sales. So think carefully about what that actually means, because the revenue is scaling so much faster than the stock price is appreciating. The stock is genuinely cheaper on a forward-looking basis today, up 21% than it was yesterday before the run. Does that sound crazy? It's simply the math of hypergrowth, and this exact valuation anomaly is precisely why Wall Street analysts are now aggressively hiking their price targets. Wall Street remains overwhelmingly bullish, holding an overweight consensus rating on the stock. Let's go through the calls. Goldman Sachs' Alexander Duval recently reiterated his buy rating with a $286 price target. Citigroup maintained their buy at $278. Baird holds an outperform rating at $250. And then there's Northland Securities, representing the ultimate bull case, setting a street-high price target of $410. Just think about that top target for a moment. $410 represents a massive 75% upside from our current spot price. And it's not a number pulled from thin air. It's anchored by the company's multi-billion-dollar backlog of contracts from Tier 1 hyperscalers. So the big question naturally becomes, how do we actually trade a historic setup like this one? Let's build the playbook. Here is the exact tactical playbook, and I'm going to give it to you for two different types of investors. First, for the swing traders in the audience, look to enter on minor pullbacks in the $220 to $224 range. The goal is to let the stock establish solid support above the weekly R1 pivot of $219.55. Then, protect yourself. Set a strict daily close stop loss below $187, no exceptions. Your upside targets are 240, then 250, and finally an aggressive $280 to $286. Now, for the long-term investors, those thinking in years rather than days, the verdict here is a strong buy and hold. The strategy is simple. Ignore the daily noise and volatility and accumulate shares on any pullbacks toward the $163 to $198 zone, targeting that long-term valuation of $410 and beyond by 2030. But before you act on any of that, there's one final critical catalyst sitting right on the immediate horizon that we absolutely must watch. The final piece of this entire puzzle is the upcoming Vineland data center hearing, scheduled for August 17, 2026. This is a New Jersey Planning Board continuation hearing regarding their flagship 328 megawatt facility, and it is the ultimate near-term hurdle. So consider the two paths. If the project gets approved, it will completely destroy the bearish delays thesis, and it will clear the direct technical path toward $250 and beyond, solidifying Nebius's trajectory to reach 5 gigawatts of contracted power by year-end. This single hearing is the final gatekeeper standing between Nebius and a truly historic bull run. Now, before we wrap up, I need to be crystal clear with you. Everything I've shared in this video is for educational and informational purposes only. I am not a financial advisor, and this is not financial advice. Every number, every price target, and every strategy discussed here is my analysis and research, not a recommendation to buy or sell any security. Investing in high-growth stocks like this one carries significant risk, and you can lose money. Please always do your own due diligence and consult with a licensed financial professional before making any investment decisions. Your money is your responsibility. So, let's bring it all together. Today we watched Nebius execute a violent 21% breakout, powered by a rare alignment of blowout fundamentals, a brutal short squeeze, a volatility crush, and a self-reinforcing gamma loop, all while the smartest institutional money quietly loaded up. Whether this is the beginning of a run to $410, or whether Michael Burry's depreciation thesis proves the bears right, the story is far from over. Now I genuinely want to hear from you. Here's my question for the comments below. If the Vineland hearing on August 17th gets approved and the last bearish argument collapses, how high do you think this stock can realistically run by the end of the year? Drop your price target below. I read every single one. And if this deep dive brought you real value today, please smash that like button, share it with a fellow investor who needs to see this, and subscribe to Calvin Mateo so you never miss the next big move. Until next time, this is Calvin Mateo, and I'll see you in the next one.